Hey guys, so welcome back to the channel. Today I have another trading strategy which I'm going to backtest for you over 100 trades. I will first tell you about the indicators we're going to be using, show you a few examples, and then perform the 100 trade backtest. This strategy involves two trading indicators, the MACD and the EMA. So guys, if you want to support this channel and receive exclusive access to all the strategies we've backtested so far, please check out our Patrons page. We will also have a Discord live chat which you can use to ask any questions to the community. The first 30 people joining the middle tier will automatically have full access to the top tier at no extra cost, allowing you to send a strategy for me to backtest. So I've seen a few of you have joined already, so thank you so much. I will create a video similar to the one you're watching and present everyone with the results. So please consider having a look at the first link in the description, and I hope to see many of you on the Discord community. So the moving average convergence divergence, also known as MACD, is a trend following momentum indicator that follows the relationship between two exponential moving averages of a security's price. The MACD line is calculating usually by subtracting the 26 EMA from the 12-period EMA, and the result of that calculation is the MACD line. The 9-day EMA of the MACD line is called the signal line, which is then plotted on top of the MACD line, which can function as a trigger for buy or sell signals. The traders usually buy the security when the MACD line crosses above the signal line and sell the security when the MACD line crosses below the signal line. The MACD indicators can be interpreted in different ways, but the more common methods are crossovers, divergence, and rapid rises and falls. And the second indicator is the famous EMA, exponential moving average, which is a type of moving average that places a greater weight and significance on the most recent data points. The exponential moving average is also referred to as the exponentially weighted moving average, and it reacts more significantly to recent price changes than a simple moving average, which applies an equal weight to all observations in the period. So this backtest is based on the daily time frame on GBP JPY, and this backtest will be over 20 years. So here's the strategy. It's pretty simple. We go long when the price is above the 100 and 200 EMA. The 100 EMA is above the 200 EMA, and the MACD is positive and it must be crossing down. And similarly, we go short when the price is below the 100 and 200 EMA. The 100 EMA is below the 200 EMA, and the MACD is negative and it must be crossing up. We place the stop loss at the last swing. We don't have a maximum number of trades that we can have open at any given time. We have a strict 1-to-3 risk to reward ratio in order to lock profits. And when the open profit reaches 1R, which is the amount that you're risking per trade, we move the stop loss to break even. So the price will either hit the break even or the take profit. So let's get on the charts now so I can show you a few trades and then we'll dive straight into the backtest. All right, here we are on the daily time frame with GBP JPY. We'll go ahead and add the indicators. So the first indicator that you want to add is the MACD, moving average convergence divergence. Then you want to add two exponential moving averages, so you can click twice that they are added. And then we'll go ahead and change the settings of the first EMA. The first EMA will be 100. You can change obviously the color as you wish. I will choose red and arrow, and then the second EMA will be 200. And that will be in white and slightly thicker. The MACD indicator will be a fast length of 21, slow length of 3, and signal smoothing of 3 as well. As you can see, it smooths both of the lines pretty well. All right, so if the price is below both EMAs, both the 100 and the 200 EMAs, then we're looking for short positions. And while we're looking for short positions, we want the MACD to be negative and to be crossing up. So in this case, it is crossing up right here on this candle. However, the price is not below the 100 EMA. So we can't enter a short position. However, on this candle right here, you can see that the MACD crosses upward on this candle. The price is below both EMAs, so we can go short. And go short right here, and we place the stop loss at the last swing, and we're looking for a 1 to 3 risk to reward ratio. So that is a successful trade. And then for long positions, when the 100 EMA is above the 200 EMA, we're looking for long position. The MACD needs to be positive and it needs to be crossing down. So in this case, we have a long position that we can open. We open it after this candle. We place the stop loss at the last swing, and we're looking for a 1 to 3 risk to reward ratio. In this case, it hasn't reached a 1 to 3, but it has reached a 1 to 1 risk to reward ratio, which means we would have moved the stop loss to break even. So this would have been a break even trade. Let me show you a few examples just before the backtest. So here are a couple of examples. We've got a nice bullish trend, got the 100 EMA above the 200 EMA. We're looking for long position. The MACD is positive right here. It closes downward, so we go long. We place a stop loss at the last swing, and we are aiming for a 1 to 3 risk to reward ratio. So that is hit very nicely. Then we move along here again. The MACD crosses down. We go long. We place the stop loss at the last swing. That plays out over some time. Successful trade. And then we go long again right here. That is a successful trade. And for short positions right here, the 100 EMA is below the 200 EMA. So we're looking for short positions. The MACD needs to be below 0. It needs to be negative, and it needs to be crossing up, which is the case right here. There's a very nice 1 to 3 risk to reward ratio, successful trade. And the criteria is met again right here. The last swing high was at this level. However, you know, if you would have been a bit more conservative, you could have moved your stop loss at this level, at the last resistance level, which is here. This would have been most probably a break-even trade. You would have been stopped out here. So let's perform the backtest now, see how this performs over 20 years, and then I'll see you for the results. So there you go, guys, the backtesting results of GBP, JPY. We had a maximum drawdown of 14% while risking 5% per trade with a risk to reward ratio of 1 to 3. We had 40 wins, 29 losses, and 31 break-even trades with a maximum of 6 wins in a row and a maximum of 3 losses in a row. So that gives a win rate of 58% just over 22 years. The net profit was 1,207%. So if you would have started with $10,000, you would have ended up with $130,000 after 22 years. So this is a very long-term strategy. As you can see, it is profitable. That gives an average of 50% per year uncompounded. The fixed risk to reward ratio is really powerful, as well as the combination of the EMAs. The EMAs worked beautifully in filtering out the horizontal, market conditions. So if you combine this across 5, 6, 7, 8 currency pairs or financial instruments, this can easily be a 100% per year strategy. So let me know what you guys think in the comments, and I'll see you in the next video.